Good morning and welcome to Charting the Markets on Friday, the 19th of January 2024. Yesterday, US markets finally reverted to the upside after a dismal start to the week, and did so as the S&P 500 information technology sector hit a new all-time record high, and as the US House of Representatives basically approved another stopgap bill for March of this year, pushing the financing of the US debt further out into the future. And we also had some positive data out of US building permits, which rose more than expected, and jobless claims plunging to a 16-month low, all of which was positive for US equities, which rallied and also helped Asian equity markets earlier this morning to end on a positive note, except in China, where the lackluster economy there is still weighing on the Chinese indices. So let's look at actually before we look at the FTSE 100, I also like to mention that Japanese inflation came in much lower than expected earlier this morning, and basically slid to a 17-month low, and core inflation to an 18-month low, both of which was really positive for the Nikkei 225. And also helped basically dollar yen rise a little further. And I'll look at that in a minute. But let's look at the FTSE 100, which earlier this morning started off on a positive footing amid those rising US and Asian equity markets. But then it started to come off again as UK retail sales fell the most in nearly 3 years, and recession fears once again become something that investors are talking about. So you can see here we had a Harami pattern, which is also called an inside day on the bar chart yesterday, and broke out of that to the upside today, which technically speaking is actually a bullish trigger for a buy signal here, provided we stay above Wednesday's low at 7,403. That could still lead us higher towards the 200-day simply moving average here in red at 7,566 and higher over the coming weeks. But short term, as you can see here on those very weak retail sales in the UK, we've come off again and are testing the breakout level at the moment. So technically speaking, it still looks as if we could see a reversal of that sharp downtrend we've been in since the beginning of the year. And this will be the case as long as we stay above 7,403, simply because of that inside bar or Harami breakout to the upside. You can see here there was another breakout to the downside, which was less risky because it was in the direction of the previous trend, and that led to the sharp decline we saw this week. And with regards to further support, though, if we were to fall through 7,403, this week's low, then we have support going back to September and October of this year, and also to the beginning of December. And that comes in between 7,384 and 7,369 on this daily financial bet on the FTSE 100. But a failure there would put the October low at 7,258 back on the plate. Now, if we look at the European markets and, for example, the DAX 40, the German stock index, you can see here that the retracement lower since its December high around the 17,000 mark has been much more gradual than what we've seen on the FTSE 100 daily chart just now. And here we slid on the daily financial bet on Wednesday to 16,344 and then had that bullish reversal take us yesterday and earlier this morning to 16,657, but still below this 1 month downtrend line, which currently acts as resistance around 16,688. So further retracement likely short term for the DAX, but we may have some really good support at Wednesday's high at 16,543. And that ties in also with the 11th of January low at 16,534. And I like it when we have previous highs and lows which coincide with within a few ticks or so or points, because they give you good support areas going forward. And then below that, we also have the 5th of January low at 16,444, which may act as support. But given the strength in the advance we saw yesterday, and given the fact that this body, the difference between the close and the open on this daily candle yesterday engulfed the previous body, that's called a bullish engulfing pattern, the odds are pretty high that even if we were to see a small retracement lower today, next week further upside could be seen with regards to the DAX 40, and we may even resume our long-term uptrend we've been in since October of last year. And the picture is quite similar with regards to the S&P 500. As you can see here, it's actually looking much more positive than the FTSE 100 or the DAX. And all American markets have actually outperformed European equity indices since the beginning of this year. And you can see here, we dipped down on Wednesday to 4,715, but held above our support line here and are now within a whisker of our 4,803 January high. And if I zoom out, you can see here, going back on a monthly chart, we are basically trading very close to the January 2022 high on this daily financial bet, which was made at 4,817. So that is literally within reach now. And further upside looks to be in store, as you can see here. Yes, we had a sideways consolidation, but as long as we held above 4,664, the early January low, it was just a sideways consolidation in a very clear uptrend. And now that we are in the process of perhaps overcoming the current January high at 4,803 on this daily financial bet, we may break to new highs. And as I said, 4,817, the January 2022 high, is the next upside target, provided we stay above Wednesday's low at 4,715. The US dollar, which started the week on a stronger footing on pared back rate cut expectations by the Fed, seems to have stabilized over the last few days. And you can see the inverse of that on the daily euro dollar chart. And as you can see here, we slid down with regards to the euro dollar cross to 108.45, which incidentally was where the red line is interacting at the moment with the price chart, which is the 200-day simply moving average. So that acted as support on Wednesday and yesterday. And today we're trading in a very low volume, low volatility, sideways trading range below the orange line here, the 55-day simply moving average at 108.99. And also below yesterday's high at 109.06. So further sideways trading with a bearish bias likely to be seen with regards to the euro dollar. Now, let's not forget that the Fed blackout period, in which Fed members may no longer comment on monetary policy, will start after today's speakers have spoken. And because of that, volatility with regards to at least monetary policy will likely diminish over the course of the next few days before the next Fed meeting. And here, from a technical perspective, not much is going on with regards to the euro-dollar chart. We still have a series of lower highs and lower lows, which is the definition of a medium-term downtrend. If we were to fall through the red line here, the 200-day simple moving average, and also this week's low at 108.45, the next downside target I would have is the 6th of November high at 107.56, and also that tying in with a December low at 107.24. So this whole area between 107.56 and 107.24 would be the next downside target zone for the euro-dollar cross. And for the bulls to be back in control, we need to not only take out Thursday's high at 109.06, 109.6, but also rise above this December to January downtrend line at 109.16. Only then could we envisage a retest of the psychological 110 area. The British pound against the US dollar is in a similar position in that it has risen from its October lows, but then started to trade sideways since November of last year. As you can see here, we're in a very clearly defined sideways trading range. And yesterday, we did rally on more positive news for the UK economy, but earlier this morning, retail sales coming in and falling for the most in the last 3 years nearly. That has put a dampener on the advance in the British pound against the US dollar. As you can see here, we topped out at around 127.14 and slid back towards 126.65. Not much really going on. More sideways trading likely at hand. Good support coming in between the late December lows and the current January lows between 126.12 and 125.97. Failure there would probably take us to the red line here, the 200-day simple moving average, and also the mid-December lows between 125.52 and 125.03. So that is a possible downside target area if we were to fall through 125.97 perhaps next week. For the bulls to be back in control, we really need to take out the highs seen back in mid-December, late December, and also early January between 127.86 and 128.28. And ahead of there, we've got some resistance coming in at the November high at 127.33. Now, earlier on, I mentioned the inflation rate in Japan falling quite significantly to 2.6% in December, which was weaker than the 2.8% reading in November and also weaker than expected. And it was the starkest decline for 17 months in the inflation data seen out of Japan. And core inflation is also down. It's at its lowest level in 18 months. And all of that basically led to the advance we're seeing in dollar yen here slightly stalling. We went up to 148.80, but have since come off slightly on this lower reading for the Japanese inflation. And that then also translates to basically further, or it did earlier this morning, weakness in the Japanese yen against the US dollar as rate normalization for the Bank of Japan is perhaps not that much to be considered if the inflation rate is coming down pretty significantly. So despite of that, from a technical point of view, we still remain within a clearly defined uptrend channel and have been trading in that channel since the early January first few trading days. And from a technical perspective, provided we stay above the last reaction low, and that's quite a long way away. That is the Friday from last week at the 12th of January, which was made at 144.36. Provided we stay above there, we have a series of higher highs and higher lows. So therefore, the uptrend should likely continue and take us towards the 149.75 late November high and also the psychological 150 area over the coming days and weeks. So I wouldn't be surprised if further upside were to be seen, even if short term we may retrace slightly. And there is some minor support on the way down coming in at the 21st of November low at 147.15. And then we have another one here at the 11th of December high at 146.59, which are potential support levels for this currency pair as well. The gold price is kind of interesting because it managed to rise slightly on the weaker dollar over the last few days. But the oil price is also something we should look at. And let's begin by looking at Brent crude oil. And as you can see here, what we've seen is basically a sideways trading range since the beginning of the year. And we sort of held above the $75 mark and stayed below the $80 mark. And at the moment, over the last 3 days, we've been rising again on heightened tension in the Middle East. We have further missile exchanges between Houthis in Yemen and also ships in the Red Sea, and retaliation by US and UK warships, which have fired missiles into Houthi military installations in Yemen. And then yesterday, we also heard about missile exchanges between Iran and Pakistan, all of which has led to a rise in the oil price on worries to do with future supply, and that despite at the moment lower demand coming out of the world's largest importer of oil, China. So you can see here that the oil price has risen on Brent crude oil to the orange line here, the 55-day simple moving average at 17,911 on this futures contract. Above there, we've got the resistance line going back to December, which comes in at 79.74. And then we have last week's high at 80.53 as potential upside targets ahead of the high seen back at the end of December, and also the red line here, the 200-day simple moving average between 81.44 and 81.54. So basically, as long as we stay above this week's low, which is the last reaction low, a low on the daily candlestick chart, which is lower than the one to its left and to its right, which was made at 76.28, provided we stay above there, further upside should likely take us to above the psychological 80 mark in the days ahead. And gold, if we look at gold, spot gold, as I've just mentioned, has risen over the last day or so as it basically left this downtrend channel we've been trading within for much of January, and did so on a stabilizing US dollar. And you can see here we had a low just below last week's low, $2,014 on Wednesday, which was made at $2,002. And then we formed this Harami pattern, or this inside day, if you look at it on the bar chart, and we're breaking out of that to the upside, which for me is a technical buy signal, at least short term, with a stop loss below $2,002 per troy ounce. And if that buy signal were to prove to be valid, we should be rising back up again towards last week's high at $2,062 per troy ounce over the coming days. I'd like to finish up on natural gas prices, which have fallen over the last few days, despite the current cold snaps we're seeing, definitely in the UK, where we had minus temperatures overnight, which is quite rarely the case here, but also over much of Europe and in the US. And interestingly enough, the prices of gas in the US, natural gas, have come off, because basically investors are looking forward to what the forecast will be over the next few weeks. And there we will see a milder weather hitting the US and also the United Kingdom, for example, this Sunday, where the temperature might rise by over 10 degrees more than what it is at the moment. And that has led to a drop-off in demand. And you can see here natural gas prices falling through their December to January uptrend line earlier this week, and are now heading back down again towards that low seen in December to between sort of around 221 on the front month futures contract. And you can see here that we've once again topped out, and that this downtrend we've been in since November of last year is likely to continue and to take us lower over the coming weeks and days. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG. Have a lovely weekend.